my fellow traders? How are we all doing today? So today I'm going to be making an analysis towards the new week on gold. So today is May 10, Saturday, May 10, 2025. And as we know, the markets are basically like closed. And well, at this time, I'll be making an analysis of what some of the things I look forward to to happen on gold. So some of the reactions I want to see gold making, before I take a trade. So basically, just everything that will guide my trading for the next trading week. But before I do that, let me just make a quick um, breakdown on the way I trade, on one of the ways I trade actually, and it's going to be with a live trade anyways, and it's one of the trades I took earlier this month. Yeah, so it's like a very good textbook example of a very a good entry when I'm trading gold. So okay, I'm just going to use replay mode. So I think that trade was somewhere on the 1st of May or something. Yeah, so yes, and this was the level I was looking at. Okay, so I'm just going to go into replay mode just to show y'all I took that trade, how I arrived at that trade before we then go into the analysis for the new week. So I'm gonna start this from here. Just take it from here. Okay, so and I took this trade on the 1st of May. This is the 4-hour time frame, by the way, and this is gold XAUUSD. So what I saw was, okay, we broke structure right here. So if you do not trade or understand SMC or ICT concepts, then this video is probably not for you. Just go and look for your retail concepts or something, someone else. This video is not for you. This is for the ICT guys. So yeah, I saw that we broke structure here on H4. Okay, my higher time frame starts from the 4-hour. I would only find myself on the weekly time frame if I'm trying to look out for something, or I notice that price is heading towards a key level. Yeah, maybe like a weekly high or a weekly low. Those are the times, most of the times, I go down to, or I go up to the weekly time frame. But most of the time, 4-hour time frame is the starting point for me, and then down all the way to 15 minutes time frame, and then I take my entries on the M1. Okay, so I know a lot of traders that say, oh, don't trade M1 is risky, blah 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 blah. But if you know how to read market structure, you should not be running away from M1. Market structure is the same across any time frame. Even if you are basically trading the 10-second time frame, you should still be able to see the charts if you are a good trader. Yeah, so I could see that here market broke structure right here, took out liquidity first, broke structure, so giving me a very strong range. Yeah, and then did it here again. So now at this point I was a little bit skeptical because I looked at this and I said, okay, this looks like a strong range, because yeah, I can see clearly, obviously, the market swept liquidity with style. It swept liquidity with style, right here before moving up, right? So the market did that again, but looking at that range, and if you are a trader that has watched candles print a lot, you could almost swear that this this range is not going to hold. Because if I was to trade this range, I would be looking to take an entry from somewhere here, mark out probably this order block, or use this by going down to maybe H1. looking for something, right? And taking a trade from here. SMC concepts, we all understand that. But then looking at this, it wasn't looking pure to me. I just felt like nah, because we have this here and price just basically left it, went on to create another high immediately. So from my experience of looking at charts, I can almost tell that everything in this range from here is just one. Even though it looks like okay, it did this, I consider everything here as one range. I consider it as one full range. Okay, so in as much as this swept liquidity and it's also like a strong range, it is not all strong range is all strong ranges that you actually pay attention to. It depends on how the range looks like, the nature of that range. For instance, now if you look at this range does not have any form of inducement to induce traders to actually come into this trade. There is no form of inducement on this trade. And even if I was going to take this trade, if I was going to be serious about this range, although I did not take it, I would have taken it from, just mark this out as liquidity, and then my entry would have been somewhere around here, right? And I would have still made some profits, because this is H4, yeah, and I still have M15. I will have to wait for the market structure to shift on M15, and then look for a short trading opportunity to the upside, at least 50%. Whenever I'm not sure of a range, I always do that. I will just look for a short opportunity to go long from here or go short depending on where the market is moving, and trade it all the way to 50% of that range. For instance, if you look at this, right, and this is 50%, so I would have, I'm not taking a swing anyways, but on the M15 I would have probably been done around here somewhere. So that's what I would have done if I took that range. So all, it's not like all ranges are not tradable. Most ranges are not tradable here, but you have to understand that the market will do anything it wants. The market could have come to this range and just gone all the way up, and if you decided not to trade it, you would have missed that, right? Even from the higher time frame. So that is why we trade in accordance with the higher time frame. We look at the higher time frame, mark literally almost every possible zone you can see on the higher time frame, and then go into the lower time frame, wait for that market structure shift. Okay, so I'm not going to make all those diagrams explaining that. Probably in future I will do that, but I'm just trying to give a quick overview of the way I take my trades. Okay, so when I saw this, I was like, no, right? I wasn't even ready for that risk because I was already, inside this internal range, trading this internal range, right? But in the long term, I was waiting for price to come here, to come and do something to this range. Okay, sorry. I was waiting for price to come do something to this range. And for me, this is basically a change of character here. So price is moving down, but at the same time, I still respect this guy. I feel like this guy is strong, is the lowest low you can find at the moment, right? So getting to this point, I felt like, okay, now to me this is liquidity. This right here, see, this is liquidity because I'm pretty sure some SMC traders would have seen this order block right here and said, oh, okay, this is another block, it has imbalance, you can see a fair value gap here, 1 2, right? And then I would have entered from here or from here, and then trade it all the way up. Oh, textbook stuff, right? Yeah, it's usually that easy, but that's what they make you believe. But I wouldn't have done any of that shit because this is liquidity to me. This right here is liquidity to me. This is inducement. It's going to induce traders to buy early, and then the big guys are going to use the stop losses, to fuel their orders to move all to the upside. So when I saw this, I knew that okay, there are, as a matter of fact, there are instances where I would actually take a trade from here. It depends on how that range looks. Like I said, we are reactive to the market. It depends on how that range looks. So that is why I pity people that just trade patterns. Because somebody said, oh, do this, and when you see this, just buy. When you see price, do this and do this, then you can just take it. So when I say just follow the pattern straight to the textbook, you don't even understand what the market is doing. You just follow your mentor, and anything your mentor draws, oh, it's a pattern, it must look like a triangle, it must look like a trapezium, and then you go into the trade because that's what they told you to, without actually understanding the market dynamics. So when I saw this, for me, I felt like, in this particular scenario, I said, no way, this is definitely inducement. This looks too clear to me. Like, this, everybody is looking at this candle. As a matter of fact, if I see a zone and it's too obvious, I know that it's a trap. Yeah, when I see a zone that is too obvious, I know it's a trap. So I most likely will not trade for there. If market decides to tap into it, right, and keep going up, that is fine. I accept that I lost that trade, right? But it's better than going into a trade I'm not sure of. So when I saw that, I said this is liquidity, and then I marked out my zone from here. Now you would ask me why here, because if we follow textbook rules, you look like, but this, if it is not an order block now, it's not, it's just there. I mean, it's just one candle. I mean, I'm not into candlesticks, but some people will call this maybe indecision or something. Like, it's just this candle. Why did you mark this? Now that is where you understand time frames, top down analysis, time frame alignment. What a candle looks like on H4 is not what it looks like on H1, right? Because now, the reason why I marked this, and I'll show you why. Now I have marked this as liquidity. Done. Good. So now, I looked at this. After marking this as liquidity, I most definitely thought to myself, where is the next zone I can trade from? There is no clear supply, no clear order block or something. So where should I be marking, right? If this is liquidity, I can't just wait for price to just come, take this liquidity, and then just keep going up. There has to be something, right, that price is tapping into. So that is where you go down to H1. Now when you go down to H1, you start to see things a bit more clearly, okay? Because all I'm looking for at this point is a supply zone. I'm not even looking for an order block. Okay, there are different concepts here: order block, fair value gaps, supply, demand. You get it, all comes down to what you are trading. Oh, sorry, in this case I'm looking for a demand zone. A demand zone to buy, sorry, not supply. Supply is to sell and demand is to buy. So I'm looking for a demand zone, right? So I'm not even looking for an order block. There are cases where I look for an order block, cases where I look for imbalances, cases where I look for just demand or supply. In this case, I'm looking for a demand, right? And after zooming down to H1, I can see my demand clearly. And you would want to ask me why, yeah? Because now you are looking at this, you still don't see any clear order block. I mean, the only other block that looks clear, seems to be this, and it looks like it's been mitigated already. So it's easy to conclude that, oh, this trend is done with. I mean, this range is done with, it's been tapped into. But I can see my order block clearly, and it's just here, it's right here. And why do I consider this an order block? Well, if you know how to read candlesticks, you know that this, I mean, this is not even my order block, sorry, this is my demand zone. You know that this, what, right, price went up, came down, right, came down, then pushed down. Now this is a rejection, which means that price had already come all the way down, and then this candle pushed up all of a sudden, right? Pushed up, and then did what? Created another candle, which was this, right? Then did this, did this, did this, and then went up. That is simply me just reading those candles right now. I could choose to zoom lower to the 15-minute time frame, but I don't want it to get too noisy because I've seen what I'm looking for already. So now I have seen a supply zone here, and that supply zone is right here, because if I read this let me take off the chart. If I read this in terms of candlesticks, look, if I read this in terms of candlesticks, I mean, this is basically a range. It's just represented in candlesticks. 1, 2, this happening, right? Internal range, and then a final break of structure. Where is this? Where is the demand zone? The demand zone is right here. This is the origin. I'm not just trading an order block because everything has to be order blocks. No, I'm trading something. This is the origin, which is what I just marked. Okay, that is the origin. And if I zoom down to the 15 minutes just to show you that, you would see it clearly, much more clearly on the 15-minute time frame, just sitting right there. Okay, what do you see? On the 15-minute time frame, you can see this. So look at what I marked. Even without going down to the 15-minute time frame, just from the 1 hour time frame, I could read the structure just from that candle. Now, what did I mark? I said what? I marked out the supply zone. And if I was even to use the 15 minutes as a guide, right, if I was to boil down to the absolute 15 minutes, I will most likely be marking this. But I feel like if I mark this one, then I might actually, the markets may not tap into this guy and it may just leave me, right? So I'm tapping into the most likely, like the median zone I can find at that point in time, that I feel like, okay, price is going to react from it. And it doesn't have to be super precise, because even after it taps into this zone, I'm still going to come down to the lower time frame to look for a market structure shift, right? For what I mean is this is what this is H4, right? Let's assume this is a range on H4, and then now there's a supply zone right here, right? And then price taps into the supply zone on H4. So let me just mark the supply zone like this, and then I will make this red just to signify that this is H4. Okay, and then price taps into the H4 supply zone somewhere here. Now, no matter what I try to do or try to refine as this supply zone, it doesn't really matter on H4, because at the end of the day, whether price comes to this extreme end to do something, or it comes here to tap it or anything, by the time price gets here, I'm still going to boil down to the 15-minute time frame. And the moment I get to the 15-minute time frame, this is what I want to see. I want to see, right, on the 15 minutes markets coming. Let me change this to white, sorry. So on the 15 minute, I want to see price do this. The moment price taps here on H4 on 15-minute time frame, I want to see this happening, right? Price is bullish, right, before getting to this point. Bullish, 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 right, all bullish until it taps into this place. Now the moment price gets here, I want to see a market structure shift right here, right, and then this happens, and then a confirmation back into another area of interest, which would be another supply zone on the 15 minutes. And then when I find that, that is my entry, and I'm following the trend all the way down on the 15 minutes. So the white arrows represent the 15 minutes. So I'm not just trying to just trade blindly from H4 and just put my entry right here and say, okay, price has tapped my area of interest on the H4, so I'll just put my stop loss, and then I take profit. Oh, I'm a good swing trader and all that. I mean, if you calculate the stop loss that that this will give you, is going to be massive, because this is H4, for God's sake. This is H4, so you're going to get a very massive stop loss that your account can't even carry. So, but coming down to the 15 minutes, it minimizes that risk for me. I'm able to get a more precise entry on the M15, right? So that is what I mean. That is just me explaining that in a textbook way. So no matter where I mark it, right, I still feel like, because of what I've seen on H1, this is my optimal entry. Okay, and even without zooming in, you could see that we drew out the structure properly just from H1, right? Up, down, right? Up, down, up, down, all the way, just from identifying, just looking at the candles, the way the candles were reacting on H1, just from there. So that's what happens when you know how to read candles. That's the level of precision, right, you get when you know how to read candles. You don't even need to zoom all the way down. Okay, so now I have marked that, and then what I did was this. I've marked this as my supply. Sorry, I keep saying supply. I love supply so much. I mark this as my demand because I take more sales than I take buys actually. So I mark this as my demand zone, right? And then this is liquidity to me. So now I'm waiting for price to come into this area, right? I did not sit my ass all day waiting for price anyway. I took a lot of trades in all these ranges here. I took a lot of trades before price got here. Okay, so I'm just telling you, I'm just using this particular trade as a case study, this one, because this one was a major one, because it tapped into a major 4-hour zone, right? So tapping, waiting. Okay, so let's play this eventually. So let's play this, right? So price, I mark that out, waiting for price, and then eventually price tapped into that zone. Now when price taps into this zone, what do? The next thing I do is, it's time for me to go down to the M15, because now I am going to be looking for a market structure shift on the M15. I'm not just going to trade this blindly. I'm not just going to set a limit order or wait for a 4-minute candle confirmation or anything. No, I'm not just going to do this. I'm going down to the M15. This is actually a 1 hour, so we're supposed to look at it from the 4-hour anyway. Okay, so now I'm going to go down to the M15 to look for market structure shifts. So you can see that eventually price ended up disrespecting everything here. If you had marked another block here, you would have gotten stopped out, because you can see that the market swept that liquidity away. You can see that, and immediately it got here. You see the reaction, very sharp reaction, very, very sharp. I could have even choose to just enter with confirmation from the 1 minute from here, but it's too it's too dangerous. I've learned not to trade that way, so I always wait for confirmation on the M15. So market structure shift, you can see now we're on M15, right? This was a break of structure, right? And then now market should be giving us a change of character right here. So now what are we going to be waiting for? We're going to be waiting for price to tap into what? Our next level of demand, the 15-minute demand in this case. So now where is my 15-minute demand? For me, I will take this candle is supposed to be more like my demand, but because of the size of this candle, I'm not comfortable with it. So if I take this candle most of the time, I will just divide it into two and just take it from here, or I do this instead. Take this wick right here, because at the end of the day, if you've looked at what I did when I drew out those that diagram, I followed what? The candle to make structure. So down, this is like indecision, so I don't even want to know what happened there, but let's just say up. And then what happened? Price moved down, rejected, moved up. What does that tell you? This is supply. It's that simple. This is demand. I keep saying supply. This is demand. Okay, so this my optimal zone. So now all I'm waiting for is for price to return back, right? And then tap in. Then when it gets here, I am waiting for another confirmation. So you can see that my trade has a lot of confluences. Now there are a whole lot of other factors that I put in before I take a trade. A whole lot. Not confusing, but all of them have they are in this, they have the same, theory, the same idea, but confluence is put together. I still use sessions, kill zones. I still use previous daily high, previous daily low. On occasions, I even use the moving average. But I'm just telling you that even without those things, I still see my trade clearly and I know, okay, what I want to execute. Whether I lose, whether I win, I still know what I want to do. So once price gets here, I'm still going to wait for the 1 minute time frame to give me a market structure shift and then tap into another supply, and I'm going to be ready to buy this. Okay, so now let's play it. So we've marked out our 15 minutes. Let's play. Good. We've tapped into it. Very sharp, very easy. You see, so because now you can see that if I had tapped this, if I had used this as my supply, you see this giant candle, it's too big. If I had used this as my supply, it's like a trap. You see, people that bought here, they would have lost, despite the fact that they were on the right side of the market. They analyzed everything. Look at it, their stop loss probably like this or something. They would have still lost. I mean, why is the market that petty? Yeah, which is why we have to ensure that no, whatever zone we are taking, it's the highest probability zones possible that you can think about. If price does not get there, then forget it and move on to the next trade, right? So you can see price tapped into it, into that zone, and then what? Now I am going down to the 1 minute time frame. Now on the 1 minute time frame, what am I looking for? Like I said, another market structure shift. This was exactly how I took this trade. Another market structure shift on the 1 minute. Now this is 1 minute. Please tell me, can't you read the market structure on the 1 minute? You can read it. I can read it. This is it. When I've already followed the higher time frame, I'm following my plan. Why should I still come to the 1 minute time frame and be lost? Because this is a zone. All I need to do is wait for price to get to that zone, respect it, give me a shift, right? This was a break of structure, right? And then now market has shifted, giving me what? A change of character on the 1 minute time frame. So now all I need to look for is my what? My demand zone again, and that is where I will take my trade. Now I have the smallest stop loss I can think about. So now if I'm going to take this trade, I will look at all this. I'll say, okay, this is one demand, but this looks too far to me, because now this is 1 minute, and as much as possible, as a matter of fact, I should already be in the trade. As a matter of fact, if I want to enter, I could just decide that okay, once market breaks this high after the close of this candle, I enter here, right? And my stop loss, oh sorry, I enter here, my stop loss would be all the way down here, right? I'm already in a very good zone to buy. Honestly, I'm already in a good zone to buy. But because I'm looking for tighter stop losses, doesn't mean I should overdo it, because now the market is already, I mean, look at it. After the market has broken this range, right, changed character, if I use my Fibonacci and use the principles of premium and discounts, you can see, can you see, we can buy at a discount, at a very good discount, because we already, this is premium, right? Price has left premium, it's coming into discount already, it's already inside discount, almost even in deep discount. This is it. So at this point in time, people are already gearing to buy. They're gearing up to buy. What are we waiting for? Right? Like, look at it, we are already in discount. So as a further confluence, right, I can see this is one demand zone, one, this is another demand zone, two. Now for me, I would wait for both. I would just wait. Okay, if price doesn't respect this, then it will most likely respect this. But one thing is certain, my stop loss is way below these two, right? So whichever one I enter, I'm already in the trade. So for me, my entry was right here. I wasn't waiting for anybody, because I mean, it has happened. I'm already in discount, so why shouldn't I buy? And then my stop loss, I take my stop loss zone from the 15 minutes. I don't just place it from here. I go down I go back to the 15 minutes. So my stop loss is usually I look for, this is the low, right? Now I look for the candle after that low on the left side. This is my low, right? This is, I consider this because this is where I marked out. So I take this, I take it as my low. This is my invalidation spot, right? If price crosses this guide, then this trade is as good as invalid to me. So I put my stop loss below, a candle below that low. So you can see a candle below that low. You can see how far it is, just to give it space, give that trade space to breathe, despite the fact that because I've already had a good entry. So why should I, squeeze my stop loss and put my trade at risk? So right, so a candle below this low, this is my own personal way anyways. You can have your own way of putting your stop loss, but this is how I do mine. A candle below that low, and then now that I've gotten my stop loss, I can stretch out my take profits 1 to 4 every single time. 1 to 4. So now 1 to 4 done, marked out. So all I need to do is wait for this trade to play out. So let me just reduce this so we can go back to, let's just play from here. Let's play from here since we've already marked it out on M1. So this one is invalid, yeah? Price, let's assume price did not get there, and this is the one we entered, right? So now 1 to 4, and then let's play it out. Let's see. Good, sweet. I mean, look at that, right? Look, let's stretch this out. At this point I'm already in break even. I've even moved to 1 to 1 already, and we keep playing it, and TP almost smashed, not smashed yet, almost, but definitely going to be smashed. You can see TP smashed, because I'm basically just targeting this high right here. TP smashed. Can you see? It took me 3 good time frames, but the same thing happened. I waited for the same thing on the 3 time frames. That's what you call a quality setup, right? And it's still going to go up, right? But 1 to 4, I'm good. I am out of this trade. So this is how I trade. Okay, this is just a usual day example of how I trade. Okay, so, and that is it. That is how we came about that trade, starting from the 4-hour time frame. So now I could still choose to swing this if I wanted to, right? I could choose to swing this trade, because I mean, this is a very good zone, right? I'm not exactly going to trust this entire range to hold or expect that price, would come all the way up. No, it might not happen. It might not happen, but at least if I use my strategy, I can see that, okay, internally this is a break of structure. I can see structure here, right? I can see that price has swept something. Look at a very nice supply zone looking at me right here. I mean, yeah, supply looking at me right here, and then this is a break of structure. Although it's internal, but it holds. I trade that too, right? So if I'm going to swing this, I will most likely swing it all the way to this very point. Most likely swing it all the way to this very point, and I'm okay with that range. That is it. Everything after that, I'm just going to sit on my hands and wait for the market to print, give me a reaction. I will wait for the market to do something, and then I will react. I'm not just going to assume that, oh, the market is going to go all the way up. No, it will not happen. It doesn't happen every day. Let's play it out. Let's even see if that happens. I mean, look at that. It got all the way to this point, although it did not respect this, but at least we respected ourselves. Right, we respected ourselves. So you can see that the market wants to react to this other block. I didn't even see that. Other blocks are very, very powerful. God, this one, breaker, this breaker block. So you can see the market reacting from that. So that's just that, right? Simple, easy trade. Even if I came down to this breaker block, we would still enter this trade using the same method. we would enter this trade using the same method that we did here. I mean, this is still a zone, right? If we say okay, H4 entry, this is a breaker, price as disrespected this guy, right? A change of character again, or a market structure shift, whichever one you like to call it, right? And price has tapped into this guy. So whichever way you like to look for it, your choice. But I mean, look at this. If I come down to the M15 15 minutes, right after price tapped into that, what would I wait for? I will wait for a market structure shift on the what 15, and then 1 M15, then change of character M15, and then now you see the market doing a lot of funny things here, right? But ranges are created, but all these are weak, right? So for me, what would my entry be? I can see a breaker block here, a very nice breaker block looking at me right here. I may consider this, but I will start from here, most likely this guy, right? And I will just wait and just sit and wait for price to get there. So let me change this to M15 entry, right? Wait for a very nice breaker block and play it out, see if price gets there. If it doesn't get there, you can see it's created another structure. Then I know that I'm done, right? Price is not going to come here ever again, because now price has swept liquidity right here and it has broken structure. So I will be focused on trading this range right here. So that is it, right? That is it. So let's analyze, let's look at what we can expect to happen next week, right? Let's look at what we can expect to happen next week. So okay, back to H4. Okay, so what we can expect to happen, okay, so now so far with the market structure that we've marked out already, let me just take all this out so we can keep the charts clean. So now we already had a change of character. This is real life, like real-time data now. So this is liquidity to me. It's a sweep of liquidity, right? Inducement liquidity sweep, and the market used that to fuel its move to the upside, tapped into this guy, and then started trending downwards. So now looking at this, I would say, okay, what looks to happen right here, right? So the market is trending downwards. By the way, we have an all-time high for gold sitting here. This is around 3.5 price, 3,500. A lot of people are looking at this level. I'm very interested in this zone, very interested in this zone. This is an all-time high for gold, and if price gets back to this place, I'll be looking out for some things to happen, which I can't explain in this video. So but that is noted. So when I'm trading, I look out for some things. I look out for the previous weekly high, the previous weekly low, then the previous daily high, and the previous daily low. So I mark out those 4 zones because those 4 zones usually contain a whole lot of liquidity. So apart from other zones that I mark out, I mark those zones out because those zones, they influence how price moves. If you have a zone, that is sitting after one of these zones, it's most likely that price is not going to get there, because one of these zones will affect it, either the weekly high, weekly low, daily high, daily low. It will affect how price reacts, and even possibly change its direction entirely. So let's mark them out. So for the previous weekly high, let's go to Monday. This is Friday, Saturday, Wednesday, Tuesday, Monday. Okay, so for the high of this week, I would take this is the high of the previous week. Previous weekly high is right here. Then the previous weekly low will be somewhere here. Since this is Sunday, this is Monday, so I will just take this. I will take this low right here, because I mean this is a low, so even if Sunday started from here, I do trust that the markets will take this as our actual liquidity. So this will be our previous weekly low. So this is just me doing an analysis of what I think will happen next week, and just showing the way I trade. It's not financial advice in any way. It's just my own opinion on the markets, right, and what I expect should happen. And if it doesn't happen, I am ready to adjust and switch my bias anytime. So I'm not strongly biased on the market. So previous weekly high marked, previous weekly low marked. Then the next thing I want to do is, okay, so this is a change of character. Price tapped into this breaker right here. So now I would expect that, cool, this is a range from starting from, where's my fib, starting from here to here. We have a range, right? This is our discount, this is our premium. So now I would expect that price should come all the way to a zone of interest on the premium, on the discount, sorry, right? And then react from there, right? Just do something, come to the discount zone somewhere around there and then just buy. But now I have some zones marked out which I believe are potentially liquidity. And then seeing this now, I can tell that, okay, for a while, or let's just say for a good part of next week, gold is going to be bearish, because I can say that, okay, gold is moving all the way into this direction. So before gold gets there, it's going to take a while. So for now, gold is bearish, even though overall I am still bullish. But for now, gold is bearish, because this is the range, right? This is impulse. We're in the impulse. The price is basically going up, right? And then now these are retracements. You can see retracements. It's just simple reading of the chart. Retracement, and then after another impulse, right? So that is what I expect, textbook nature. But now I've marked out previous daily high, which is liquidity, which I know, which is an indicator that, yeah, price is coming to haunt this, to take out this liquidity. So I don't know what you ICT guys call it. You have your buy side liquidity and your sell side liquidity. Yeah. So let's say this is, I don't know, maybe this should be your buy side or something. But I know that, yeah, there's liquidity here. Price is coming to take that one out, right? And then this too, most likely. So now I have those two marked out. So, and I know that this is a range, right? So which means that when price gets here, the only place I am willing to take, let me take this off, please. Let me remove all this. The only place I'm willing to take a trade would be when price gets somewhere here. That is after this previous weekly's low, liquidity has been swept. That's the only time I know that I would be willing to take a risk, to take a buy. Okay, so that is when I know that I will be willing to take a buy. So now, knowing this, and then even looking at this range, I'm still not sure, and I cannot exactly say, I cannot fully assume and say, oh, okay, this range is just going to hold and price will just get here and then to just buy. I can't say that, because price may still disrespect this zone. Price may still get here and disrespect it. I am I'm ready for that to happen as well. So I need to be reactive. When price gets here, I want to see certain movements that would, tell me that okay, we are going to be bullish, even if it's short-term bullish, even if I have to be bullish to just 50% of this range, and then now wait for further, reactions from the markets. I'm willing to do that. Okay, so now marking this, let me make this H4 red. So I use red for my H4 zones and white for my M15 zones. So marking this now, I say okay, I'm basically bearish. So I'm waiting for the new week and I will be looking to be bear, right? But where do I start to be bear from? Right? Where do I start from, right? So now this is just H4. By the time I get to the M15, I might be bullish again. But at least I have an overall idea of where my trades are going and what I need to be doing, right? So now what I want to do is go down to H4. So give me a minute. So what I want to do is go down to M15. Sorry, what I want to do is go down to M15. So now on the M15 we are going to mark out some levels as well. We are going to mark out previous daily high and previous daily low. So now we are going into a new week. So this new week ends right here, right? By the time, if you look at this now, this is Friday, today is Saturday. By the time it is Sunday again, this previous week should become our new weekly. Okay, so the weekly low should still apply, but I think the weekly high Monday, okay, I think it's still the same anyways. It's still the same thing, still the same. So M15, so now on M15 we are going to mark out the dailies, the daily levels, right? So we are going to mark out previous daily high and previous daily low. So first off, I will use separators to mark out the days, right? So this is 11th of May, so 12th of May, and then the new week, okay, the new week will start from the 12th of May. So let's just mark this out, 1 2. So this is basically Monday. Everything in this range is Monday. So then let's mark out the 9th, Friday. So basically everything from here to here is Friday stroke Saturday. So the market stopped right here. So this is all Friday. This is what? Friday. And then now we are looking for what? Thursday. Today is Saturday. So I should be marking my highs on Friday. So let me just do that. So if I'm to mark my highs, then I will say okay. So if I'm to mark my highs, I will say this is Friday, right? Saturday, Friday, Saturday, the Monday. Markets will move again on Monday. So when I'm trading on Monday, right, my previous daily high will be 1 2, right? So let's mark them out. 1, previous daily low, and then this one will be my previous daily high, previous daily high. Okay, so if anything in this video is too advanced for you or something, then you go find your level, because I'm just doing my thing. I'm not really trying to teach anybody the basics of trading. It's just basically for people that already have an idea of how trading goes, and just basically sharing my insights personally. So it's not like it's a full-blown training or a beginner thing. So previous daily high, previous daily low, these two zones, liquidity resting, liquidity is resting right here, liquidity is also resting right here, right? Serious liquidities. And before this happened, so this is Friday. If I traded on Friday, on Thursday, where would my lows be? If you want to talk about previous daily highs and lows, right? My low would have been here. This would have been my Thursday's low, and then this would have been my Thursday's high. Now look at what happened to Thursday's low. Can you see? Liquidity was swept right there. The moment price swept the Thursday's low, what happened? A rally up, right? So that is just one of the things I use my previous day high and previous day's low for. So now this one, you know, is no longer there because it's been raided already. So now I'm focusing on the previous day's high and low for the M15 immediate time frame. Yeah. So now let's mark out the market structure. So for market structure, I can see that, well, I can see some, where do I start? Okay, let me start from here. You can see a sweep of liquidity right here, and then I can see a break of structure. So it's a major range, a very major one. Break of structure. Then now I can see another one right here, right? Let's just say from here to here, then another, I thought I used this, and then another break of structure, right? So now this range is pretty much invalid to me because there is no inducement. Price has even disrespected it. I wouldn't even be waiting for anything to happen here because I mean this guy looks pretty solid to me, right? So now let's factor in other things. Let's bring in other forms of liquidity that we have. I always like to identify every single liquidity. I won't just trade market structure blindly. I won't just say okay, this is inducement, break of structure, inducement, break of structure. So that means I have a supply zone, here, and then I'm just going to wait for price to get there, and once price mitigates it, oh, I'm going to joyfully sell. No, I'm not going to do that. Instead, I need to look for every areas where liquidity might be sitting. I'm deleting this. This is irrelevant to me. Okay. So now, what am I expecting to happen on Monday when the markets are open? Okay. What I want to see is this. First off, I want to identify liquidity. Right now, I've marked out some. This is previous day's high, and this is previous day's low. So what I want to do is mark out sessions, kill zones. So I mark out Asia from 1 to 4. I'm not going to explain how or what this is, but you should know what, if you trade SMC or ICT, you should know what sessions are and how they influence the markets and the liquidity in every session. So I mark out another from 7 to 10, and then I mark out another one from 1 to 4, 1 to 4. So let me just, okay, I mark out another one from 7 again, 7 p.m. till, I mean, this session is not really over, so I'm just going to delete this one. I'll just delete this. Okay, so now when I mark out session liquidity, I use it to also identify where liquidity may be sitting. So as far as I'm concerned, every high and low of a session, there's liquidity there. One, there's liquidity here, there's liquidity. As you can see that the liquidity has already identified itself as what? Previous days low. So you can see confirmed liquidity here, there's liquidity here, there's liquidity here, and you can see the way price is reacting to everything, sweeping those liquidity. There's liquidity right here, there's liquidity up here as well. You can see what happened when price swept this liquidity, moved all the way down. Okay, so now that we've marked out all the possible liquidities, so let's focus on the one that matters. Let's focus on the immediate one. So I can see that we have, this is the last session, right? And this is basically London kill zone. Okay, 1 2 4, and then I can see that there's liquidity sitting right here. And on Monday, I'm expecting what to happen, because if you go back to what we did on H4, what were we expecting on H4? We're expecting price to come back to this level, this red zone right here. I'm expecting price to come back to this red zone and for this previous daily low to attract it. So you can see there's two previous daily lows that are likely to attract price, to magnet price down and down, right? Two previous daily lows. So I'm looking for price to, one daily and one weekly low. So this is where I think price will be coming into, right? So which is why what I am sort of bearish. But now at the moment on the M15, we look bullish. If you can see, price is making moves to the upside, right? We look bullish on the M15. Even though we are not imposing, we are basically retracing upwards, which means that at the end of the day, even though we are bullish, the sellers are still in control at the very moment. So you can see we are retracing slowly upwards, right? And once the seller comes back in control, what do you think will happen? It's going to be one move, right, to sell. So we are retracing upwards, right? So what does that tell me? It tells me that at the very moment we are bullish, right, but slowly bullish. So, and the new week is coming close, and price is most likely going to be looking to first buy into somewhere, into an area of supply or something, before the sell move begins. But for price to buy, for the big guys, the institutions that will resume trading on Monday to buy, I feel like they will need to sweep some sort of liquidity to fuel their move. And that liquidity is looking at me right here, this guy. I suspect this one, because now this is a session, this is London session, this is the liquidity below London. Then to top it off, there's trend line liquidity right here. So you can see I'm marking different sort of liquidity. There's trend line liquidity right here, there's session liquidity looking at me right here, there's a previous daily high waiting to be raided. People's stop losses are sitting here. People that believe the price is going to be bearish, they are waiting here. The institutions are waiting to resume on Monday to raid these guys, to use them to fuel their own movements. So what do you think? And then now, if I come here, now what do I expect? I expect that price is going to do this on Monday, right? This is my own analysis. I expect that price is going to do this, sweep this low, probably all the way to this place, and then rally all the way up. That's what I expect. So when that happens, I'll be looking to buy. I'll be looking for confirmations to buy. Okay. sorry. So now, once price does this, now I know that okay, price will most likely, after doing this, sell into what, this area I am waiting for, this zone. So where do I think price will sell from? I think price would sell, because we are in a range. If you remember, we are in this range. We're in this range starting from here all the way to this. Because as far as I'm concerned, this range here doesn't mean much to me, right? Unless the market says otherwise, right? I am not the market, but I just feel like this range is not strong enough to me. If price is going to respect this particular range, then it will most likely disrespect my bias here as well, and then possibly use this. This looks like a breaker block to me, right? Possibly use this and then just disrespect everybody and keep going up, right? So if that happens, I will also be bracing for that. But for now, what I see is what, price raiding this, going up, and then now we are in this range. We are in this range, and from what I'm seeing here, I feel like now this range doesn't have inducements. It doesn't have liquidity of any sort, and if a range doesn't have liquidity, I basically assume that the top of that range is the liquidity. So for me to be on the safe side, I can't take this range and say, okay, I'm going to trade from this supply zone here, and then when markets gets there, I sell. For me to be on the safe side, I wouldn't want to do that. Although I would look out for it, but it might be a trap, because price might get there, give me all the possible confirmations, even give me a market structure shift on M1 and end up taking me out, right? So I will most likely look forward to it, because I can tell the market may most likely use this. For instance, the market may just use this guy as our inducement. The market may just say, okay, this is an inducement enough for us, let's sell, right? Because it's very close. It's very, very close to this supply zone here, this order block. It's very close to it, as you can see. So the market might decide to do that. The market might decide to do that as well. So I can't exactly neglect it. But a higher probability entry for me is this guy here, this supply zone. That is just lonely, that nobody really thinks means anything. That's the highest probability one for me, because this one is so obvious. The institutions know. They know that everybody is going to be looking at this place. They know. And they will most likely use it against us. Because the moment people are entering there, oh, that's a lot of liquidity. Oh yeah, sweep them and then sell. So I would look at it, and at the same time, I wouldn't. So I would wait for confirmation. And if I take a trade there and it loses, then most likely, yeah, that is one loss, right? But guess what? Most likely this will give me what I'm looking for, and I'm 1 to 4 and I'm 3R up. That's trading. You can't always be right all the time. It's not possible. No matter how much you analyze the market, you can never be right 100% of the time. So I'll be looking forward to this zone, and I'll also be looking forward to this zone. So now there are certain ways I could use to give myself further confluence, and some of those confluences may be moving averages, or I even go back to H4 and look at what is happening with an eagle's eye view, right? So if I go back to H4, I'm pretty sure I would see something that interests me in that zone, most likely. So let's go back to H4. Let's see. Okay, so let me just delete all these arrows and all that. So now on H4, what do I see? I can see that, okay, so what we analyzed on H4 here, if we followed our analysis, what we analyzed was that what, this is weekly high, weekly low, right? Price is currently impulsing to the downside, and I can see retracement right to the upside. So now that is one confluence that okay, retracements to the upside, impulse to the downside, which means that price is bullish slowly, right? Moving bullishly slowly, which means that the sellers are still going to take control one way or the other, right? So that is what makes me think that price would sell, even though on the M15 it looks like price may buy. So it's possible you see a good setup on M15, but you still have to come back to the higher time frame to understand what price is doing on the higher time frame, because the higher time frame is king. So now you can see right here, right? This reconfirms my bias. Like, okay, I'm willing to stay on this bias. I'm not going to be changing my mind, right? We've changed character impulsively. And then now we are retracing downwards, right? We are retracing downward, but with impulse as well. But internally, as you can see, internal structure. Internally, we are retracing. The cells are strong internally, but on the higher time frame the cell is weak, right? And then when price gets here, we are looking for it to do what? Give us something, a push. And then for further confluence, I can see something very interesting. I marked this zone, and then if I look at this thing from the higher time frame, it doesn't even look sure. This particular zone, this first one, why I'm not so sure about it, look at it. I mean, if you want to mark out the zone on H4, if you were going to mark out this order block on H4, what will we mark? We'll mark this, right? And we'll do this. But on H4, it's basically mitigated already. I mean, what are we looking for in that zone again? It's basically mitigated. I mean, even more than 50%. So on a normal day, we shouldn't even be doing anything here again. This is liquidity. People have entered this trade already, and all the market wants to do is sweep and take them. That is what, even though it may not happen like that, there's a 50% chance that it will go otherwise, right? But that is what I see, and that's what I want to react to. That is what I want to react to at this very moment. So this already tells me that okay, I should not trust this zone, right? To avoid any possible losses for myself, I am going to delete this zone. It's as good as gone. I've looked at the H4, I've reconfirmed that. I can see trendline liquidity. I can see okay, price is most likely going to sweep here and come up. First buyer, second one, price will come here, go down. And then again, what do I see? I can see something very interesting here. I can see a fair value gap. I can see imbalance, guys. I can see imbalance. Look at this zone that I marked. Did you notice that it aligns? Let me take this out. It somehow aligns, even though we did not analyze it here before, but now it aligns, and see clearly it aligns with a fair value gap right here. Now I don't trade fair value gaps, but when I take an internal structure, there is supply zone inside, there is a lot of things, and then I see a fair value gap on the higher time frame that confluences with that spot. I'm going in. I mean, look at this zone for instance. If after analysis this place was a lower time frame, I was seeing some supply zones inside this area here, and then I came to H4 and I saw this fair value gap. What's to stop me from entering? That's mad confluence for me. Mad confluence. What else could possibly tell me that that place is wrong? Even if I lose that trade, no, that place is confluence enough for me. Look at this fair value gap. 1 2, and then look at this guy. What does this guy look like? It doesn't look like liquidity to you. It looks like inducement. Like, yeah, induce them, let them sell. Inducement below, inducement above. Sweep them, then move up. So now you can see fair value gap. So even if we did not analyze the lower time frame before, simply just marking out this fair value gap, right? Simply just marking out this fair value gap alone, and then going down to the lower time frame, 15 minutes, to look for an entry there. What does that show? What does that tell you? And then you now get there and you end up seeing this. You end up seeing this, a very nice sexy looking supply zone. just waiting for you inside the fair value gap. I'm going in on that one. So for me, Monday, I'm focused on this area right here, price to sweep here, or if it doesn't, I'm waiting for it to come here, because eventually price may just not even sweep here. It may just do this, maybe just go up. Sorry, may just go up, tap into it, and then eventually use the down move to just sweep these people anyways. Any one of those two might happen. So that's just my analysis, right, for next week. For Monday, especially Monday, Tuesday, or Wednesday, all this may span across Monday, Tuesday. But if those are the only two trades I take next week, I'm good with that. That's my bias for that week. And if it's just those two trades I see, I'm good. And I'm out of the market doing other things. So that is my bias for the week. And if I'm going to further confirm it, you can see that price tapped into a zone here, right? Higher time frame level, right? Price tapped into this higher time frame level on the H4, right? And then what? It's currently trending downwards, so it's looking for continuations, right? So that's what I will expect on a textbook level. It's looking for continuations. So all I need to be doing is just look for continuations, pick this, right? This is a zone, optimal entry for me, and keep selling until it gets somewhere where I react again. But so far with what I see, that is my bias for gold for next week. So let me know what you guys think. If you think otherwise, or you feel gold is moving in another direction entirely, let's all learn from each other. Let's know what's up. Let's help each other win. And I don't know if I've finished my analysis, right? Yeah, one more thing I use as confluence, my moving averages, although I don't exactly trust them all the time, right? But at least to a certain degree. Is my network still working? Okay, to a certain degree, I use exponential moving average 1 6 200 100, at least to a certain degree. So now if I use what my moving averages are telling me, right, my moving averages are telling me that there's a short-term buy and there's a short-term sell and a long-term buy on the M15. This is 100, moving average 100, moving average 200, moving average 16 is a more stronger level. The moving average to me represents liquidity. The moving average does not represent, oh, touch me and I buy or I sell. No, the moving average to me represents dynamic liquidity. I consider the moving average as liquidity zone. So you can see where price touched this moving average. I wouldn't buy from there. Instead, what that tells me is this is liquidity. And if you remember what I marked here was what? The previous daily low, which is liquidity. That was what I marked. So I know what I trade. So if somebody comes to tell me, oh bro, what are you trading, I will tell you, I see confluences every day, right? This is it. This is liquidity to me. Previous day low. If I mark my session here, there will also be a session here that confluences with that, and then price is tapping this moving average. This is liquidity to me. So it's a confirmation that my previous day low. So if I was going to enter this trade, this is confirmation, this is confirmation, my session is confirmation. I look at this, I wait for confirmation, I'm in. So the moving average to me is liquidity. It just depends on how strong the liquidity is. So this 1 6 moving average is stronger liquidity compared to these two, and I also use it to determine the trend too sometimes. So when I'm looking at this, I can say, okay, this is what a short-term sell. Yes, you can see the smaller moving averages are selling, right? But the bigger moving average is buying. So when price now meets or something, it tells you that okay, at this point buyers will be in control, right? So that's what my moving averages are telling me. So if I'm to confluence what I just analyzed with my moving average, I would say that okay, now what did I analyze? Short-term sell, short-term sell, which could also mean, because I mean I can see the moving average here 1 2, so there's liquidity at this, I mean there's a session too, session liquidity up here, previous day high liquidity, moving average liquidity. So which means that there is the absolute possibility that price may not even get all the way up here. So now you see I have another entry. So now instead of waiting for price to come all the way up here, I now have a new entry just by using my moving averages as confluence, and I have another entry right here, which might even also align with this zone. It might align with this guy right here, just might, right? So you can see it just might. So you can see that I was most likely also wrong, right? I looked on the higher time frame, I deleted it, I came back here again, another confluence. So tells me okay, most likely let me stay there, right? So if I'm seeing this liquidity right here, right, it could even mean that the liquidity has also been swept, because I can see that the moving average, right, has been tapped into 1 2, and then price has swept, right, swept session liquidity, right, it has swept it most likely, and then it's continuing downwards. So now I'm not going to be confused at this point because I know what to do. And what I'm going to do is this: first off, I'm not even using this level, right? Second, I'm going to just mark this. If price sweeps this previous day high, then this will be my entry. I'll just take it from somewhere here, and it's just one criteria. That criteria is that what if I see whichever price taps into first, because now I can see that there is a probability that price has swept liquidity here. There is a probability, right? The liquidity has already been swept and price is continuing, right? But now I'm just going to wait whichever one that price sweeps first. So if price on Monday, right, depending on how the market wants to make, start with some consolidation and all that, right? Asian session, which will all start with consolidation, right? Or let's just say accumulation. So now if this happens and then price raises this liquidity first, it does this, guess what, this is the guy I'm going to be focused on. I am going to be buying from here. Once I buy from here, I know that this guy is most likely not going to hold, because now the buyers are in control, most likely sweeping this guy, and then are going to take it all the way up as expected. So you can see accumulation already. What concepts do you trade? If you trade that, if you trade AMD, your own is also here too. So you can see that all strategies work hand in hand, whether you are using moving average, whether it is SMC, whether it is ICT, it all works hand in hand if you know how to just look at the markets, whether it is support or resistance. I trade support or resistance, but in a different way. I trade it in hand with liquidity. So you can see accumulation, and then you can see what manipulation, and you can see what distribution. You see, even though I do not trade AMD, but you can see that I just pictured it happening right here, and that's basically what I'm thinking of right now, right? So most likely, but if price doesn't come here by Monday, possibly just or Monday until, and then just taps this guy first, raids this guy first, then I would assume that okay, that liquidity wasn't swept properly and they are looking for more, so we are selling. So I'm reacting to the market, whichever zone it reacts to first, I'm in for it. And my moving averages does give me that confluence. It just told me to pay attention to this place in case I might have missed it. So you get that, yeah? So now as you can see, and I don't even think this price will be coming here, because with my strategy with the moving averages, the moving average has already been tapped, liquidity has been swept, right? Price moves away from areas of liquidity it has already swept. So please, why would price decide to come back, This is everything here is literally accumulation, right? So I expect a manipulation, another set of liquidity to be swept. So why will price decide to come back again and tap this moving average? What liquidity is price trying to create here again when it already has enough, and then just keep going up, and then this moving average is just going to be following, right? It's just this moving average is just going to keep following price. That's what I expect it to do. That is how I look at price. So, and this will confirm that okay, yeah, in the long run, right, short sell, long buy until we get to my actual proper point of interest, right, for a sell, and then now we can be talking about coming back. Sorry, can be talking about coming back. So that's how I look at the markets. That's how I look at the markets. So moving averages out, I'm done with them. That's what I use my moving averages for. I do not use them to determine to as a signal for entry. Oh, once price touches the moving average, sell. Once price touches the moving average, buy. No. As a matter of fact, if we want to go back in time, just to show you what I just showed you, to tell you that moving average is liquidity. That is what I see moving average as. Moving average is liquidity. Look at this place. Look here. Price tapped moving average. What happened? Liquidity is created. What happened after liquidity is created? Liquidity is swept. You see? Price tapped. So it's not an entry, it's not a signal for entry. It's a confluence for me. Okay? Price taps moving average. Liquidity is created. What happens? Liquidity is run through. Price taps moving average. Liquidity is created, is run through. Price taps moving average. What happens? Liquidity is created and then it's rated. It taps. Let's do this one again. Price taps moving average. What happened? Liquidity rated. Price taps moving average. Here again, even though it doesn't tap and just runs through, it's still liquidity to me. Liquidity. So imagine just creating a strategy whereby you are just trading off moving averages. Oh, it taps moving average, sell. You would most likely be on the wrong side of the market most of the time. So moving average is liquidity to me. It's not a signal for entry. So yes, that's to tell you that yeah, indicators are also important. They are not just designed there for show. So when I see people saying, oh, they don't use indicators, they don't use indicators, okay, no problem. Everybody with their style of trading now. Happy. It's not a flex. Not using indicators is not a garden flex. It's not a flex. Use what works for you. This is it. Price taps indicator, moving average. What happened? Liquidity is created, and then liquidity is what? Swept. It's not a flex. It's a tool. We have several of them. Use them. Don't stop trying to flex and be showing off. See, price taps moving average. What happens? Liquidity is created. Liquidity is swept. Price taps moving average. Liquidity is created. It is swept. I mean, I don't need to explain too much. I don't need to explain myself, but that's just the everyday thing, yeah. So we'll take them off, buy to moving averages. We are done with them. So guys, let me know what you think about what gold is doing. Let me see your own views, your own ideas, and let's win together. Until the next video, guys, bye for now. Peace out.